Hello everyone, welcome back to Dr. Tao's Quant Lab. Today we are moving into subsection 1.6.3, the anatomy of a position. In financial markets, the concept of a position is your fundamental building block. It represents the exact exposure you have to a particular asset. Before we can talk about advanced trading strategies, you must understand how to define, size, and calculate the cost of a position. This is the absolute core of risk management. Let's start with the four basic status of a position. First, opening a position. This is your initial execution, buying or shorting a stock to establish your market exposure. Second, a held position. This simplified means your trade is currently active and has not been closed yet. Third, closing a position. This is when you execute an equal and opposite transaction to exit the market and turn your exposure back into cash. Finally, forced liquidation, also known as a margin call. If you are using leverage and your losses wipe out your account equity, the broker will step in and forcibly close your position to prevent further losses. You lose control here, which is the situation we always want to avoid. Let's put some numbers to this terminology so it is crystal clear. Suppose you deposit 1 million into a brokerage account. If you use the full 1 million to buy a single stock, you have taken a full position. If you use 200,000, your position size is 20%. If you use 500,000, we call that a half position. If you start with 20% and later decide to buy more shares, that is called adding to a position or scaling in. If the stock goes up and you sell a position of it to take some profits, that is reducing a position or scaling out. And if you sell all your shares, you are liquidating the position. So, how much of your capital should you put into one trade? We generally classify position sizes into three categories. A light position is less than 30% of your total capital. A moderate position is between 30% and 60%. And a heavy position is anything more than 60%. Now I want to add a quick note here. There are no strict, legally defined rules for these thresholds. They are a psychological and risk management framework. Depending on your personal risk tolerance and the volatility of the market, you might be a conservative trader who defines a heavy position as anything over, say, 40%. That is completely fine. The key is that you have a defined framework. This brings us to the most critical part of this lecture. Managing that position size. Stock prices are volatile. The short term is unpredictable, and I guarantee you will make mistakes. We must understand the math of losses and gains because they are deeply asymmetric. Look at figure 1.11 and the accompanying table in your notes. If you lose a certain percentage of your capital in this first column, then recovering that loss requires a much larger percentage gain on the second column. The formula to calculate your required recovery is 1 divided by 1 minus your percentage loss minus 1. I will leave the reading this paragraph and the proof to you for this formula. Okay, so you are going to verify this formula on your own, but that is not hard. Now, let's look at this red rows in the table. Say if you take 10% loss, you only need an 11.1% gain to break even. That is very manageable. But if you let a losing trade run and take a 25% loss, you now need a 33.3% gain just to get back to 0. If you take a 50% loss, your remaining capital is cut in half. You now need a 100% gain. You have to double your money just to break even. And a 75% loss, you need a massive 300% gain to recover. And the graph next to the table visualizes this hockey stick curve perfectly. As your losses push past 20% to 25%, the effort required to recover literally explodes. This is why professional strategists mathematically mandate cutting losses well before they reach 25%. Wealth is built by avoiding ruin. Because of this risk, professionals rarely buy a full position all at once. We use scaling strategies to average our cost and manage uncertainty. Keep in mind, your total position size should be planned and fixed before you open the first trade. Do not randomly add 2 positions. Here are 4 common ways to build a position. It's strategy 1 in subsection 1.1.1. Okay, first, regular investing or dollar cost averaging. You invest equal amount at fixed time intervals over a long horizon. This is perfect for passive investors buying the, for example, S&P 500, as it averages out short-term volatility over decades. Here is the annual yearly K-line for S&P 500. We're going to cover S&P 500 later, but if you can see this figure, right? If you regularly invest for the past years, you will have a huge gain. as time goes. And again, I screenshot the figure here to figure 1.12. And you can have a close look at here as well. Now, second, we call it pyramid buying. For example, allocating 40% first, then 30%, then 20%, then 10%. You deploy the largest amount at the initial entry and add smaller amounts if the trade works. This maximizes profits if your timing is perfect, but it carries higher initial risk. Third, equal-weighted buying. For example, 3 entries of 33.3%. This smoothly balances your entry risk. And fourth, inverse pyramid. For example, allocating 10% first, then 20%, then 30%, then 40%. You start with a tiny filler position and only add larger amounts as the trend is strongly confirmed. This dramatically reduces your early risk, but we may lose chance if the price goes up quickly. Now, once you have built a position, you need to know your exact cost. Your position cost is the weighted average purchase price of your holdings. Let's do the math on a standard average price. Suppose you buy 60 shares at $70, which costs $4,200. Then you buy 30 shares at $50, costing $1,500. Finally, you buy 10 shares at 60%, costing $600. Your total capital deployed is $6,300. You hold 100 total shares. Therefore, your average price is $6,300 divided by 100, which equals exactly 63 per share. But here is a pro tip. Experienced traders use what we call the trader's cost or adjusted cost basis. When you sell some shares and take partial profits, you mentally adjust your cost basis to reflect the remaining capital you actually have at risk. Let's continue our example. You own 100 shares at an average cost of $63. The stock raises to $80 and you decided to sell 30 shares. You receive $2,400 in cash. What is your new trader's cost? You take your initial cost, $6,300, subtract the cash returned, $2,400, leaving $3,900 of your money still in the market. You divided that by your remaining 70 shares. Your new adjusted cost basis is roughly $55.71. Lowering your trader's cost gives you a massive psychological advantage. Your initial cost was $63. Now it is $55.71. If the current market price is $80, you can hold through severe market volatility with almost zero stress because your break-even point on these remaining shares is incredibly low. while your trading app will calculate the current averages automatically, as a trader, you must understand the math happening behind the screen. Finally, let's touch briefly on taxes. We will cover this more later, but the golden rule is this. Taxes apply to realized profits. When you actually close or reduce a position in the US, the default accounting method is FIFO, first in, first out. The first shares you bought are the first ones the broker sells. So you can usually specify exact tax laws if you prefer. The reality check here is simple. Taxes are just a transaction cost of being a profitable trader. Paying taxes is okay, given that you earned money. It just decreases your net take home, but you still make a profit. Never ever hold onto a deteriorating losing position just because you are trying to avoid triggering a tax event. That concludes our deep dive into the anatomy of a position. In the next video, we will look at the specific directional mechanics of going long versus short selling. See you there.